Capital markets don't grow very well with complex tools. They grow well with simple tools. We've proven this in the green bond market by establishing simple tools. Simone will talk about the green bond principles in a minute. Of course, taxonomy, we have attempted to create binary tools, simple tools, to reduce the level of friction involved for the issuer or the investor, to reduce the cost of transaction, to make it easy. I'm going to add my little tuppence worth of taxonomy session earlier by saying in the European taxonomy, we now need to, in the next 6 months, simplify, make it easy because it's got too complicated. Hey, it's a work in progress. But that's our job. That's what Martin Spolk was talking about when he talked about the usability focus. Simpler and easier. The easier we can make things, the faster things will move. The easier we can signpost things, the faster things will move. I think we're good enough crowd now. I'll get started. Okay. This particular panel, we're lucky to have with me Simone Utomak, who's the Director of Sustainable Finance for the International Capital Markets Association. And you may know ICMA as the organisation that manages the green bond principles with a large collection of other organisations involved in its governance structure. You'll see Rodolfo Fracassi from Main Street Partners, which is a green bond fund. I mean, essentially a boutique. He's probably going to tell me, no, it's not a damn boutique. It's a mainstream. But the reason why he's here is that they started right at the beginning. And the journey of funds is something we need to learn everywhere. I'm going to get Rahul Ghosh to say some words, who's a managing director at Moody's, who's going to talk about credit rating and the tools and the changes they've made recently. This is about integration into proper credit analysis of what we have to do on climate. Well, let's see what he says. And then you can ask him really tough questions afterwards, okay? I mean, you're not often you get a credit rating analyst, a senior one on a table. He's there to interrogate everyone. Bear that in mind. And then Jean-Marie Mas, who's currently a managing director at Blue Like an Orchid. What the hell is that? Well, it's a fund manager. He's going to talk a little bit more. It's a very cool fund manager. He's formerly the Chief Investment Officer of the International Finance Corporation, part of the World Bank's group, Financial Institutions Group, and set up, kind of invented what a roadshow was. I joined him on some of those, a thing called the EGO Fund, which is a joint IFC, Amundi fund to invest in emerging market fixed income. He'll tell us a little bit about the model and so on. There's a little selection of tools we have on the table here. But this is not everything, right? That's why I'm going to turn to you in a little while. And Doris Honnold in the front, one of our trustees, the Climate Bonds, is I'm sure going to throw in a couple of really cool ideas or projects that we do. I do need to tell you that one of the tools we have launched a consultation about a few weeks ago is around entities certification. It's on our website. You heard a little bit about it in a session a couple of sessions ago. It's about how we assess the corporate strategies of an organisation. It might support sustainable linked bond certification or other forms, but framework for doing that to ensure we have appropriate rigour and ambition. That is a tool. And we'll be looking to roll out more tools at Climate Bonds going forward. On that note, Simone, can you kick us off on what ICMA's got, but more to the point, what's happening? What's the gossip for people? Where are things going? And I'm curious to know where you see the biggest traction at the moment around the various tool sets that you developed at ICMA.
Yeah, thank you, Sean. You mentioned we provide the Secretariat for the Green Bond Principles. We've done that since 2014 when the principles were created and the Secretariat came to us. But not only, we now just talk about the principles because we now also have the social bond principles, the sustainability bond guidelines, which is a mix of green and social, and also the sustainability linked bond principles. So it's getting longer and longer. And the latter one is a different kind of product because it doesn't focus on use of proceeds, so not what is being financed, but rather on what's the strategy of the issuer. And that's really where the trend also seems to go. We've seen, although this is the latest one, the principles only came out in 2020, following a bond in the market from Enel, again following the sustainability-linked loans market. And it's still quite a nascent market, you could say, but it's the fastest growing market. And it's the one where there are still the most questions about. But because of that, we also, during our AGM this year, we published a lot of additional guidance, and this is really hopefully helpful to the market and will help the further growth.
Can I ask, new developments? Have we got some gossip we can share about new projects and new ideas? I mean, we're in a few working groups, but I lose track. There are so many working groups now.
We have a couple of working groups. Some of them we've had for many, many years. We have some newer working groups. We also have some task forces, which are sort of more ad hoc for just a year.
Give us a flavour.
A very big one, quite a new one still, is the Climate Transition Finance Working Group, also a big trend. Also sustainability-linked bonds that I just talked about, just mentioned the principles for those. They have kind of emerged, you could say, as an ideal instrument to finance the transition, and we have separate guidelines for that. So we don't have transition bond principles, as we often get asked about, but we have a transition finance handbook that provides recommendations as to what an issuer should disclose in order to communicate a credible transition to the market. We also continue to work on social, which is inherently, the opposite side, you could say, of the green transition. So just transition will be a new thing that we continuously, try to look at, try to tackle. There's no definition out, so this is certainly something that we need to look at. And then also we continue to look at SLBs, because as I said, there continue to be questions on that. I don't even know what's going to be the detailed agenda for the working groups this year, because we're only just starting. We haven't really had any kick-off meetings yet, but we're going to have a few starting next week. So.
Climate Bonds has a very close working relationship with Green Bond Principles and ICMA. We aim in our certification scheme to incorporate the Green Bond Principles and in our various other certifications to incorporate other aspects of the various protocols. The Green Bond Principles were not actually a creation of ICMA. ICMA took on the job and then grew them. And in fact, I was there at the beginning because it was actually Mike Eckhart, who was at Citibank, who said, what about this? Maybe we should do some rules for this market and so on. And I introduced him to Matt Hale at Bank of America, Merrill Lynch at the time, and they went off into a room and they came out with this idea. What about we do... Now, banks don't collaborate much in America, right? This is pretty unusual. And Mike then caught a plane to San Francisco, did a first draft on the plane, and shared it with Matt, and then eventually Suzanne Bukta, and then to a couple of people like Tanguy Claquin. And so 4 banks came together as the initial owners of the Green Bond Principles, which are all a codification of practices that are already there. But there was a benefit in codification to make sure that all the banks followed the board, saying this was an example of setting clear standards and being able to commoditize them so the market will grow. And then soon after they needed a home, they asked ICMA to take on the job, and ICMA did a fantastic job, I have to say, of growing that and then creating a whole plethora of other reporting protocols. It is reporting. Now,
yeah, but indeed it is, and I always try to clarify that as well. So it's not something we create. It's actually been and still continues to be so successful because it is created by the market, or has been, still is, for the market, right? So we have an executive committee which consists of in equal parts issuers, underwriters and investors in sustainable bonds, and then ICMA provides the secretariat. So it's all market participants, nothing created by ICMA. We're highly involved, of course, in all the guidance and new principles, but really the ideas and impetus as to what needs to be updated, what needs to be there is coming from the market.
How many members now in the Green Bond Principles?
So the executive committee is always 24 members, 888. And then we have a wider community of over 400 members and observers, which also is, contains all other kinds of roles, rating agencies, legal law firms, data companies, and so on. So anyone who's not an issuer, underwriter, or investor.
And I'm going to say that this market would not have grown if ICMA had not taken on that job and then socialised it globally. So regulators around the world have turned to the ICMA reporting principles as a starting point for regulation that started to appear in ASEAN, in Latin America, etc. It's been an incredibly powerful part. It's been a tool for growth. The market has grown.
And Sean, we have a working group at Moody's to think about the working groups for ICMA as well.
And we have an external reviewer forum, which is not a working group but a forum. As I said, we have now also fora and task forces. But yeah, it's we looked at it the last 2 years, and last year we found 98% of bonds. Sustainable bonds, I should say, globally have been aligned to the principles. So it's really, although it's a voluntary standard, it's one that's being, when issuers publish, they like to align to the principles because it gives them a clear standard, clear steps to follow, and of course investors really like that.
Absolutely. You solve some of the problems about due diligence by codifying them. Now I just want to find out this working group, to study the working group. But Rahul, tell us your story at Moody's.
Absolutely. Well, I'll also say the tool of the principles has been phenomenal for us as well as a second party opinion provider. But I'm going to talk about the question you mentioned: how are we integrating ESG, climate, into how we think about credit? And I'm going to start with a story. So about 2 or 3 weeks ago, I met with a large commodities producer. With a global footprint, I won't give you the name, and we met with their executive leadership team, myself, a number of our credit rating analysts. And this team were telling us that over the last 10, 20 years, we have done what other commodities producers have done. We have built our business on the back of globalization, on the back of China, on the back of demand for raw materials. And this particular individual said to me, but if I think about my next 10, 20 years, in a similar vein, my company risks becoming, quote, a dinosaur. And so I've been working with my leadership team to think about, well, how do we take core business and think about the extractive activity that we do and make it more palatable for the electrification that we're seeing? And how do I look at new activities as well, whether it's hydrogen or other elements that we can get involved in? And then they put a plan together. What does that mean for my CapEx needs, right, over the next 10 years? And what implications might that have for my credit rating? And a really, really fascinating, very honest and earnest conversation. And of course, as credit rating analysts, we're obviously thinking about the debt, the CapEx is important. But also, what does this shift really mean for you as a business? Do you have the technical knowledge? Do you have the regulatory and legal ramifications of this for your business? And so really, it's a conversation where we're understanding what the sort of exposure is of a company, what is the company response, and how it's looking to implement that. And I think we've heard that one I word today, interoperability, but implementation, I think from a credit rating perspective, is huge. And I would suggest that's going to be a conversation as a credit rating agency we're going to have increasingly. So if I just, the subject of today's panel is tools. And so we've just launched a number of ESG credit tools, scores, and it's 20 past 4, so I'm not going to go into scales and language, etc. But suffice to say, we have around 6,500 names at Moody's that we have now provided these ESG credit scores for. So there are a bunch of different ones, but essentially we look at how much exposure does a company have to particular issues, including carbon transition, including physical risk and natural capital, and then what is the final impact on the rating. And when I look at across all of the corporates for which we've provided these scores, 20% of our companies that we rate are deemed to have a very high or high exposure to carbon transition. Right? The exposure is there. And of that 20%, then it's oil and gas, it's transportation, it's chemicals. But in that group, just under a third, so 30% of their credit ratings are lower today, maybe one notch, maybe multiple notches, than they would have been were it not for that particular issue. And so we're having to then talk to them. Right.
You heard it here, everyone. That's tweetable, quick.
And that's where implementation is important, Sean, because then we've got to talk to them about, okay, what is your plan to deal with this? And it's not necessarily get there as quick as you can. You have to get there in a sensible way, but in a way that allows you to hopefully adjust and then adapt and potentially benefit from the transition that's taking place.
Very cool, very cool. We'll come back. There's a lot, and you still haven't talked about the committee. But Jean-Marie, you and I have been talking about this stuff, the developing market, emerging market stuff, for years. Tell us about the model that you've established with the Ego Fund you're working on now, and also the discussions you've had to have in terms of broad architecture of how we bridge this gap between emerging market demand, creditworthiness, capital pools in richer countries, and your conversations with various international bodies.
Yes. So I would like to start by the first time I met Sean Kidney. Okay. So at that time, I worked at IFC. My specialization is equity investment in banks and emerging markets global. We met in 2016, right after the COP21. Then the idea was that green bonds were endorsed by the Paris Agreement as an effective tool to channel money from developed markets to emerging markets. And I felt that banks, which are systemic in emerging markets, were resilient if they issue bonds in terms of credit default in comparison with the rating of the banks. Because the banks have a rating cap at country level, but in emerging markets, they tend to have strong balance sheets, strong capital adequacy ratio. So if you take a balance sheet of a bank, let's say in Peru, you put it in Germany, the rating would be better. So I felt that there would be a good story to buy systemic banks bond. From there, probably a good story to reorient a strategy to help them issue green bonds, so that because they would be well placed to finance green economy if the green economy emerged. So I got all these ideas. Then I met Sean, because I was explained that to do a fund, you need $2 billion strategy minimum to raise money from pension fund insurance company, and that should represent 1% of the market. So when I met Sean in London, I asked him, Sean, so what is the volume of green bond issuance, and how much last year, and what is the outstanding amount? He told me 65 billion issued globally, 220 billion outstanding. So then I told him, how can I do a 2 billion strategy in emerging markets? It doesn't work. And Sean told me, no, Jean-Marie, you should not look at it that way. You should say, because it's at that level, it can only grow, so it's the time to do a 2 billion fund. So I said, yeah, that's an interesting concept. So I didn't stop there, but then I developed two concepts. The first one is to raise a 2 billion fund strategy, which has happened, but divide the portfolio in two parts. One called liquid management strategy, the second called green bond strategy on the asset side. And the liquid management strategy, we sell the bond to buy green bond. So when you do that, you can anticipate a market growth, but raise the money you need at the size investors are looking for, and accompany the movement. So this fund is called the demand from investors. But then after that, I work on the second leg. It's called stimulate the supply. And this took the form of a $15 million technical assistance program for 7 years, funded by Switzerland, Sweden, Luxembourg, where we provide a targeted assistance to systemic banks in emerging markets so that they issue green bond instead of non-green bond. So we have a menu of activities from training, communication, database, research, case study, communication plan, and we call it stimulate the supply, and combine the simultaneous stimulation of supply and demand to create a market. So then at that point, when I look at the result, the fund closed at 1.4 billion, but it's closed-end fund, so it goes up in value by accrued interest. The fund has now more than 1 billion of bond in portfolio, and the fund closed in 2018, and the technical assistance has stimulated $4 billion. So that is quite significant number if you look at the balance sheet of many institutions. And then the program is 7 years and was launched in 2018. So it can still go on until 2025-26. So it really has worked. So that is for that. Now, at this point, what I realize is that investors, they find that the green bond market is still a small asset class. It's about 3.5 trillion for a 125 trillion bond market. So it's less than 3%. And then the second thing is if you issue a green bond, you need use of proceeds, meeting ICMA definition, and not everybody can issue that. And if you want to finance the transition, it may be more efficient to address those who pollute, who cannot issue green bond, than only those who can issue green bond. So then investors are telling me that they like the concept of sustainable development goal, which includes green bonds. So green bonds is considered like crème de la crème of SDG because you have use of proceeds, a lot of things to monitor that you don't have on other bonds, even if it's not perfect. But now the current concept is to work on sustainable development goal investment strategy, including green bonds and social stability linked bonds. So that's what I'm working on. And in emerging market, right now, investors are retracting money. And that's something I said for a long time, is that most emerging market portfolio managers, they manage open-ended fund with a performance based on an index. And what I say, that cannot work well for emerging markets because the index constantly changes, so they need to rebalance their portfolio. And if they face redemption in open-end fund, they need liquidity to reimburse investor. And in emerging markets, it's very volatile. Price bid-ask spread move a lot. And so there is incompatibility. And last week I was at the World Bank IMF annual report, and what I found interesting is the IMF wrote a report called Global Stability Report, and they have a chapter where they say why open-ended funds are not a good tool for emerging markets, which I think is an interesting development. So the fund I built is a closed-end fund with shares listed on Luxembourg Stock Exchange. So investors cannot redeem against cash, but they can trade their shares on the secondary market. And because it's listed, it meets an asset class of marketable securities on their balance sheet. That also you need to always find where you are on balance sheet of an investor, institutional investor. So that's what I can say for my story at this point.
So you've got an example of engineering work which is coming up with tools, funds in this case, to bridge gaps. Very important. Rodolfo, you've got a slightly different story, but you got in right at the beginning. Tell us about the journey of Main Street Partners, your fund, and also tell us why. How did you start? Because when you started, this was a nothing market.
Very much so. First of all, thank you very much for being here and to listen to our stories. And by the way, very cool panel because we have very different angles. I'm biased on that, of course. I'll start actually with a question to the audience. Who believes that in 20 years, 100% of the bond market, at least on the primary issuance, will be bonds with use of proceeds? So green bonds, social bonds, also sustainability-linked bonds, transition bonds, anything. Or let's say, who believes that in 20 years we will not see general corporate purpose bonds anymore? Does anybody believe in that?
I have that many.
Well, that's our team, so it doesn't count.
100% Rodolfo, 100%.
It's too much. Okay, so that's exactly the reaction I had in 2010 when we tried to launch our first green bond fund. And then we succeeded in 2011, and then again in 2015, and then again and again in 2018, and then again, and so on and so forth. So about the story. Main Street, which is the company I founded in 2008, is an investment advisor specializing on ESG. So we team up with asset managers, with insurance companies, wealth managers, and we help them raising funds, so creating funds, and then we advise them on managing the fund. And he's also a data provider. So in the green and social bond space, basically we collect data. We started in 2010, and we provide those to the fund managers we team up with. The story is, in 2009, I started seeing this market, and I was very fascinated by the concept of the green bond. Why that? Because I've been always working for 8 years before that, especially with distribution networks, with financial advisors. And being on a stage like this one, you need to convince people who actually then deal with other people's money to invest, sustainably. And it was very difficult to do it at the time, in 2008, 2009, because it was difficult to measure, what is ESG? Well, rating's cool, but, companies doing better than another, best practices. But then all of a sudden we got, these instruments, and you can tell people where the money is going, measure it, and they feel good about it because they know what's happening with the money. And so I started investigating about green bonds, and then I had a friend working at Daiwa at the time, and they were very successful in basically buying bonds on these green bonds on the secondary markets and reselling them to distribution networks in Japan. And why was that? Very curious situation, no? You think it's a super niche. But why was that? Because Japan has been in a zero interest rate environment for a very long time. So here we go, that clicked in my mind because it was, A, you got a great story, and B, interest rates are just going down. At the time, they weren't so bad, but kind of the path was obvious, was clear. And you need a story. So given that Europe went down the same path of going to zero interest rates until a few weeks ago or a few months ago, and then we thought that that was a great place to be. So we started talking to some of our partners, some of whom are here in the audience today, who are very big asset managers, and we said, why don't we launch together, a fund that invests in green bonds? So back to the story, that's exactly the reaction I had the first time when I started talking to one of them, and they were like, you're crazy. There's only 5 billion of this stuff around. We'll never know where to put the money. But then they also were crazy enough to believe in it and do it. And so the first fund was launched, and then again, more funds afterwards. And it worked. And I think what worked until now, then maybe we see what's working next. But I think what worked until now is the simplicity of it, at least from our standpoint. So I think we really need to maintain that because there is a lot of work in the background, and it's phenomenal. It's fantastic to see so many institutions, so many people working hard to make it precise, make it specific, avoid greenwashing, maybe sometimes a bit too much, but it's okay. But the key will always be when then you're in front of an audience of non-practitioners and you got to explain them what you're doing with their money, because in the end it's their money, even if it's pension funds, in the end it's somebody putting money into the pension fund, You have to be able to explain it in a simple way. And that's what I love about green bonds, social bonds, the fact that it's easy to explain. And if it's done well, you can measure it, tell a story, then of course they need to yield pretty much the same. But we should maintain that. And I think explaining them right, creating the right products, and maintaining this simplicity was really the key. And so I think that we can get to 100%. Maybe it's too bold, but I think we can get there. Because nobody wants to go back. Once you're accountable, I'm telling you where I put your money and what I do good with it, you want to keep knowing about it. That's my
Great point. And that kind of echoes what we heard in the previous panel too. It's very interesting. I kind of want to go to the audience before I come back to you folks, if that's okay. And this is our last session. We're going to talk about now, what do we need and what have we got to grow this? The objective is 5 trillion a year in 2025. I need some comments, some suggestions, please. So questions or comments? There's one here. And okay, can I give you a microphone you can read out? Great. One microphone at the front here, if I may. Any others? Hands? There's one over there as well. Just here.
Hi. Sorry, I have two questions from the people online. One is from Parish Patel, and his question is, what can be done to ease and accelerate issuance and management of GSS bonds instrument at the subnational levels? Example, states, countries, city, municipalities. And the second one is from Scott Bryson, and it's from Jean-Marie, mentioned helping to stimulate supply of green bonds as part of the fund. Could this be discussed more on if it's been successful, key learners, etc.?
Okay. Hang on to those questions. We're going to take a few.
Yeah.
Who's got the mic? Stand up, please.
Hello. Paula from the Luxembourg Stock Exchange. Rodolfo just talked about the beauty of green bonds and about its simplicity. But we discussed in the previous panels about the complexity of the taxonomy regulation, and we know that the EU Green Bond Standard actually foresees 100% of alignment to the taxonomy. My question is the EU in the right direction around this EU Green Bond Standard?
Okay. Microphone, stand up.
A question for Jean-Marie. I'm a big fan. Thank you for making the time, sir. A two-part question. So the first part of the question, I'm a big fan of growing. I'm a big fan of EM. So I'm Kareem Hanidi from Record Financial Group. We have a growing footprint in EM and Frontier as well. My question, sir, so the first part of the question is, we know about the original sin, the classic Panizza quote. How do you bridge that gap between growing green bonds and delivering hard currency and giving investors comfort around hard currency, but also allowing local markets to develop in their local currencies, to empower them, to give them freedom of policy? And the second question, similarly, so the same type of growth, but one of the key things holding us back is not just the green bonds, but the vehicle they're in. AP Ego is in a CCAV. What do investors who need daily liquidity, how do they go about this? And maybe this is for the structurers in the room. What do they do? How do we grow without them? Because we're going to need their capital, but their capital has requirements. It has liquidity requirements. How do we grow with them in mind?
Thank you. Someone else got the microphone over here? Please stand up. Put your hand up. And I'm doing a full round of questions, by the way, so I need a few on this side.
It's going to be hard to remember.
Go ahead.
Sean remembers them.
You got a
Hi,
question?
No, I remember.
Hi, my name is Pranjal Mathur from 8 Versa. I had a question to Rahul in particular and to the rest of the panel as well about credit ratings. So you were saying how ESG is becoming more material in traditional credit ratings, but I think ESG ratings are still a separate entity on their own. And is there a clear delineation on where an ESG rating might be needed versus where a credit rating is sufficient for bond issuance? Because if we want, especially for high-risk markets, like if we're looking at emerging economies or elsewhere, how do we draw the line on whether it's sufficient to just use a traditional credit rating or a separate ESG rating? Thank you.
Can I take one more, or are you at the end of your tether? Yes, I think I can take one more. Sandeep, are you in the audience? Microphone over here, please. Oh, we've got, and Dorothy over there. Okay. I'll stop after Sandeep if I can come for a second round. Please, Sandeep.
Okay. So you want me to ask a question?
You can tell us about your tool briefly first, if you like.
Okay, great. Okay, so a statement and a question. So I think what Sean wants me to say is we have a whole pipeline of deals that can absorb around $5 trillion. So that's your first year, 2025. And they're carbon negative. They displace steel, they displace cement, they displace diesel and fossil fuels. I'm a Silicon Valley serial entrepreneur turned impact venture capitalist. I've partnered with some ex-CIO of BlackRock to bring venture capital to this space. That's early stage capital. All we do is set the table for you guys. Now we need you guys to come in, refinance what we've done, and take the ball further. That's why I'm here. I'm a little bit of a fish out of water here at a European bond conference, not my normal gig. But we have all the deals you need. And I don't know if this is heresy or not, but our companies, our portfolio companies, generate 25% to 50% EBITDAs, which means that they can afford to pay more. They could pay 7, 8, 9%. So what I don't understand in talking to a whole bunch of people here is, debt. We can get debt. Now, I would love to get green bond, which is just a different type of debt, unless someone correct me if I'm wrong, okay? But you're layering all these extra requirements, making it so many more hoops for these portfolio companies to get through to get this other debt. And yet we have a time urgency and a climate crisis, and we're making it harder to get the kind of capital that's needed for a better future for our kids. You should be making it easier. So I guess
that's a rude question for us, isn't it?
So my question is, how can we make it easier and deploy the capital? Look, we need 20 trillion. So starting at 2025, that's 5, 10, 15, 20. By 2029, we can retire. So I want to ask you, the question is, how can we make this process easier to get your capital deployed in green bonds?
Thank you. I'll come back. Who wants to have a shot at what question?
Can you just summarize the questions again, Sean?
Well, Parish talked about how to make it easier for SSA issuance is the online question. What are the challenges there? I mean, there's a whole creditworthiness story. This is one of the things the IFC tried to do with some sovereigns, like Johannesburg years ago, for some first loss provision supply. There's one question, and then Scott asked how the technical assistance program has been useful. So maybe we'll start off with you, Jean-Marie.
Yeah. Well, first of all, maybe I will address your tough point first.
Good.
How do you make it easier is by regulation, standardization, database. Because right now there is a lot of requirement where issuers believe what investors want, and what investors want is not what investors believe. Yep. We have done a research on that, doing a monkey survey on issuer and investor, and 75% of time is not used adequately. Okay. That doesn't question the concept of green bond user proceed, but today it's not efficient enough, it can be improved. So that, to me, that would be the answer. So now, about SSA challenge. I would like to just give you a very concrete example which I found interesting. Okay, so our concept was to train financial institutions / banks. So we trained one, and this bank was issuing $800 million bond every year. So when they came to our training, the idea was to do a pilot 50 million green bond, because that 50 million use of proceed. Then through our training, they found that they could issue $800 million sustainability bond, because they had 750 million of social loan portfolio to hospitals, school, low-cost housing. So then they decided to go for $800 million sustainability bond instead of 50 million green bond, thanks to our training. So when they placed the bond, they did everything by the book, following all the requirements of ICMA, and it was a 12-year bullet bond rated BBB. And during the day of placement, they had, I think, $4 or $6 billion of demand from 210 investors, 110 of them in the UK, so 110 investors. So, and then the spread compressed by 50 basis points during the day. And you can compare the price of the spread relative to the secondary market trade of their previous bond. So I calculated that if you do 50 basis points by 12 years on 800 million, you save $50 million of expense at issuer level. And that, to me, is the best return you can have on the time you spend, because it took them maybe 3-4 months to do it. So basically, we need to have more demonstration effect like that, publicize them, so that we see that it works. And one of the benefits of green bonds is to diversify your investor base. So that's one thing. Then about the question about the training. So what we went through a kind of a try and error phase. And the phase one, we did training for 100 people in the room in Singapore, Bangkok, and Jakarta. Then we felt it was uneven knowledge when we trained. Then we did a phase two, when we invited 10 banks, sending 2 to 4 people per bank on a executive training campus of Stockholm School of Economics. And we brought trainers, including ICMA, to train the banker who came. So that has worked very well. But then after came the COVID confinement period. So then we rearranged all the training in e-training instead. And instead of 1 week in classroom training on campus, it became a 2-week program with like 6 half day and 12 video, actually with the voice of Simon here present, on everything you need to know about ICMA green bond principle, with 12 quiz that you need to succeed. And that was the pre-requirement to go to the e-training. And then after it went, the people were trained, and then it created, as I mentioned before, 4 billion of green bond issuance. So if you train, it works. But what we have, it's a full arsenal. We have training, communication, database, case study, research. And we did a series of 7 webinars last year, and there were like 2,000 people registered per webinar. So there is interest in these topics. And what I'm finding also with webinars, you can record and people can watch them in their time zone. So for emerging markets, it's very important. So that's what I would say
Good.
for these questions.
I just want to make a comment for Sandeep. You know, the cost of transaction, if we keep it reasonably easy, is pretty low. You know, half a basis point, you're spending quite a lot of money. In at least hard currencies and a number of other currencies, there's modest price benefit, which more than covers the cost. That's what the UK Treasury will tell you, for example. So the reporting obligations aren't that hard. They're relatively modest, especially if your portfolio is reasonably straightforward, as yours is, I know, renewable energy and so on. If you've got an agricultural policy, agricultural investment portfolio, that might be more challenging because the reporting might be more complicated. So it's sector specific. So at the end of the day, you've got to make a decision. Is it worthwhile looking at the thematic issuance for the benefits you're going to gain from investor diversification, obviously, greater access to capital if you're an emerging market, because you'll get on a desk, but otherwise hard to get on a desk, and potentially, depending on the currency you're in, a modest price benefit, which will cover your cost and get those benefits. So it looks like a lot, but I'm going to say it's a bit overblown. Now, of course, whether we've explained that adequately, that's another question. Whether we're making the rules in some places more complicated, that's another question. And I want to go to you, Simon, really, to pick up the question about the green bond standard in Europe. Is the EU in the right direction with its green bond standard, or which is voluntary, not mandatory, to be very clear in current proposals? What's your reading?
Yeah, I mean, as you know, Sean, ICMA was actually part of the HLEG and also the technical expert group, the TEC. And we were very much involved in when the EU GBS was created because it is actually based on the green bond principles.
Yep.
So we comment a lot on it, and if you follow it, you might know that it's currently still under trilogue after the Parliament and the Council presented their positions in May. So it's now under trilogue. We'll see how long that's still taking. What we are positive about is indeed that it looks like it's going to remain a voluntary standard. It was initially presented as a voluntary standard or being thought of as a voluntary standard. Then in between, we've sort of seen it going towards mandatory. Now we're back to voluntary as it looks. So ICMA thinks that's good for the market. We also like the fact that they're thinking of a flexibility pocket. Just to explain to some people that are maybe not following it so much, the green bond principles, one of the things that goes with the principles is that you have a list of eligible green projects. Under social, that's also social projects. The difference with the EU green bond standard is that you don't have a list of eligible projects. It's much more complicated, if you will. The EU green bond has to be aligned to the taxonomy, and what that means is that you have all these. You have 6 environmental objectives, basically, climate change mitigation, adaptation, and then 4 others that are currently being developed or finalized. And you have to make a substantial contribution with your activities to those. You have to not, or you shouldn't do any significant harm to other projects or rather other objectives. You have to comply with minimum safeguards, which also bring a social and governance component to the taxonomy. And then the first 2, the substantial contribution and the do no significant harm, they are further defined by technical screening criteria. So very detailed, which in a way is good, but also very difficult to do because a lot of the time we just don't have the data. So in summary, I would say it is probably going into the right direction, but maybe not do all at once while we don't have enough data. There are a lot of good components, but we will have to see. If you're interested in our detailed comments, I would recommend you go to the ICMA website. We have published comments, the last ones in July, where we comment specifically on proposals from the Parliament and also from the Council.
So work in progress.
Work in
broadly
progress,
right
yeah.
direction.
We are following it
Fine-tuning.
closely, yes. Fine-tuning needed, yeah.
Rahul, this question about ESG, especially in emerging markets, I mean, you've infected kind of answering that with what you're doing, but I'm just wondering if you've got some more colour you can give us to respond to that question about how do we tackle ESG in difficult markets?
Absolutely, thanks, Sean. There are a couple of questions I wanted to respond to, if that's okay. So the question on how do we grow faster, right? And for me, it's narrowing the barriers between the different actors. If we just look at this panel, right, we have standards, we have service providers, we have advisors, we have investors. And I'll take one example. You have green securitizations. We all want it to be bigger. We all see the potential. We have new guidance that ICMA and its various working groups have put together. As an opinion provider that's been an observer to one of those working groups, we can learn. We can think about how we integrate that into our second-party opinions that we provide. And then we can provide opinions to the market that can then be used by investors, and we can explain our approach to investors. So I think if we narrow those divides, that can really help us scale and innovate as well. On the question of ESG ratings, credit ratings, second-party opinions, so full disclosure, across Moody's, we do them all. We often get this question, what are all of the differences? And the first thing I'll say is, the sustainable investor, the sustainable market participant is not homogenous, right? We speak every day to investors that just want to manage risk and are focused on where those E&S risk pressures are. We have others that want to understand what are the policies and procedures and practices that a company's implementing? How does it compare with their peers? Because I want to engage with that company and I want them to disclose more. And then we have the investors, still small today, but hopefully growing. I care about impact. That is my number one aspect that I care about. So the short answer to that question is it's different horses for different courses, right? And I think from a credit rating perspective, we're super focused on what is the impact of ESG on credit risk. ESG ratings speak to something different, and then of course second-party opinions speak to something else. Are there areas of interplay? Yes, they are. And just going back to my previous conversation about the commodity producer, there's a relatively negative story there, and credit rating analysts can be accused sometimes of being a bit pessimistic. So I'm going to say a positive story, which is, if you look at the auto sector, we've actually seen in our credit rating tools an improvement in relative carbon transition positioning over the last 5 to 10 years, as we've started to see this sector understand the transformation, start to build facilities, start to build new products. So we're seeing an improvement in exposure, and that's leading to financing. What, 5 automakers today out of your big 18 or 20 have issued labeled debt.
Yep.
We expect that number to grow, and they're using that to essentially fund this fundamental transformation that's taking place in their sectors. So I think that's an important story. And very quickly on emerging markets, look, I think one of the areas that we're focused on, obviously from a credit rating perspective, is accurate credit ratings. But there's also this. It's important to say that lower income economies can and have seen their credit ratings improve over time. Since January 2020, I think we've seen around 45, 50 positive rating actions for low income sovereigns. And a lot of that's been built on institutional reform, banking sector reform, economic reform. And obviously, as those credit ratings come up, some of the challenges that gentleman in the corner mentioned around getting access to institutional investment become easier as well.
Extraordinary, interesting transition this market's going through, isn't it? And the very fact, I'm going to say crudely, that they've seen business in this area is symptomatic of everything changing. But Rodolfo, this question of liquidity, I thought that was an interesting question. And, is that an issue for your clients? And what's your view of some of the broader developments? I mean, do we end up looking at yieldcos or SPACs or whatever that invest? What's the story of liquidity? Is it actually an issue?
Yeah, can I answer to that in a second and before I go back to the one? That's very important, actually, is also the second point that I wanted to make. But I wanted also to answer to the question about simplicity versus complications. Raul, you just mentioned the automotive sector, so I was thinking, I know nothing about cars, honestly. If I walk into a car shop and I buy a car, I don't know even what to ask. I don't use cars much. My only car, and I use it like once a month. So the thing is, but I know something about finance. And so I think our job, given that personally I can't do anything to convince the European Union to do things in a more simple way, but also on the other side is good for our business. So I can't complain about that too much because I wouldn't be honestly. I like to be coherent. So I think European Union is doing what they think they have to do, and that's fine. I think our job is to look at that and try to make it simple for our investors. I mean, that's the key, because we cannot change that. So is going into a direction of making things more complicated. But again, as when I go and I buy a car, I don't know pretty much anything about it, or when I use my Samsung phone or use an iPhone, I don't know anything about the technology inside it, or not much. But at the end of the day, I use it anyway. So I think our job, and many times that gets a bit underestimated, is really to, well, do a very technical job in the background, but then try to explain it very simply. And the second point, back to liquidity, but also to the gentleman before that was making the point of, we got so much demand or actually offer in that side of bonds and investment opportunities. Liquidity, risk, and performance. So back to also, traditional finance, because here we're talking among ourselves, but out there are investors who, they need to cope with rising interest rates, and they need to protect their clients from risks, and so on and so forth. So liquidity is an issue, but I don't think it's the issue or the enemy number one, because the market of green bonds have become much more liquid. We see issuance every day, multiple issuances. Of course, with corporates, with credits, is never super easy, especially when the market goes a bit into turmoil. But liquidity issues is not only with green bonds, is with corporates in general. So I wouldn't mention that as the number one issue, although it might be in a way, especially maybe for specific areas of the market. But I would say duration may be an issue, because still the market of green bonds has on average a longer duration than the benchmarks or the other typical investments. And the second thing is the level of the ratings, because we're working here in an environment where you basically work with investment grade bonds, most of it. And I think these two things, and emerging markets, you are trying to sort out the issue, and you're doing a great job there. So I think the issuers in the market in general needs to think more about innovation on that front, also looking at what investors really want, because otherwise we end up in a loophole where you have the usual suspects, repeating issuers, issuing the same type of bonds. Okay, that helps a lot in terms of numbers. Then we look good because we say, okay, big percentages, big assets, but in the end, especially now that interest rates are going back up, now the thing of the story is still important, but now the returns are back being very important. Managing a fixed income portfolio is way more complicated. So we need definitely more tools on that front. So to get to that 5 trillion or 100%, whatever we believe in, definitely let's think about having all the tools that we need to manage a proper diversified fixed income portfolio. And then I don't see why any asset manager shouldn't have at least 1, 2, or 3 green bond funds. Once you have all the tools, why not? But it takes some time to get there. But it's improving. Now, the other day we saw Austria, I think, issuing a very short maturity bond, green bond. So it's moving there.
I realise I've messed up the timing. We're out of time. That means the conference is finishing up. Jesus. Can't we just keep going for another few hours? Are there any drastic last questions before I go? Dorothy's got one. Philip, did you have your hand up? Nope.
I would like to make...
And then I'm going to come up to final comments, my panel. Okay? Just quickly, Dorothy, you've got 30 seconds.
To improve the image of this ESG fund that is rife with greenwashing, you guys need to invest in real, green, profitable, and impactful projects. We have pipeline of so many, like 2 gigawatt battery storage across the UK. Channel money into real sustainable project, please. That's my closing comment. Thank you.
Thank you. I think that was a lecture. Thanks, Jean-Marie.
I would like to make a comment on the rating, because and the type of bond, because I see a lot of confusion, because you have publicly placed bond, privately placed bond. Publicly placed bond, typically 300 million, 500, $1 billion. Privately placed bond is 50 million. So there are different type of issuer, and we tend to aggregate everything. I think we need differentiated approach. The second thing on the rating, a lot of pension fund insurance companies in Europe cannot buy sub-investment grade bonds. But in emerging markets, it's a 3.3 trillion market in dollar. Half of that is China. And you have only 12, 15 countries which are investment grade. So in fact, if you want to impact emerging markets, you need to have mechanism to take money from investment grade destination to sub-investment grade destination. Otherwise, that becomes additional. If you just do a emerging market green bond, you will get the same allocation for emerging market. It goes from non-green to green, but it's not additional money flux. It may be qualitatively better, but it's not more money. So you need mechanism to credit enhanced fund to unleash more money. And what is happening is that now, so as mentioned, I was at World Bank IMF annual meeting last week, and there is a big debate about blended finance, that World Bank does not use enough its balance sheet, that they are AAA rated, but they can increase their lending by 25% without losing the AAA. So that became apparently, I heard it, a big debate. And then one of the solutions would be credit enhancement at fund level to then bring more money. And that is one of the topics we are going to see in the future.
And one of the things we're working on, Jean-Marie, is a 500 green development finance institutions project, because there are 500 development banks around the world and hardly anyone gets any leverage at all. And they can all do what the World Bank's doing and much more. So there's work to be done. With the same public sector capital base, we could massively scale up green investment if we worked at it. So that's one area. Simon, parting reflections and any thoughts on the future, because this is around what more tools we know. You see the NICBA, International Capital Market Association. We need, of course, a vast green capital market. Reflections.
Yeah, and not just green, and yeah, indeed, to stick with the tool, with the theme of tools. I've talked about the principles before, and you can really use those principles to finance a lot of themes. I talked about transition finance, which we at ICMA see as a theme. So you can indeed finance the transition using green bonds, with the likes, which the likes of the EBRD have been doing for many years already. You can also use SLBs. You can use social bonds if you want to finance the other side of the coin, the just transition that I mentioned. But there are also other themes coming up. We talk increasingly about blue finance as well. So blue to us is also a theme under green. So you can finance blue bonds, if you will, under, a blue bond is basically a green bond with a blue theme. And then there's also, under social, for example, if you want to finance gender equality, that you can do under a social bond. So you can use the tools that are there, the existing principles, and finance different themes. It's all out there.
I'll go next. So the key takeaway from the first story I said to everyone with that, the conversation with the commodity producer, I think that phase of exposure, risk, response financing is going to be a very recurrent thread when our analysts engage with companies. It's actually one of the reasons why we've brought our second-party opinion business into the credit rating agency, into MIS, so we can really look at some of those holistic links between, okay, where is that company's exposure? How is that translating into risk, to credit risk? How can they respond to that? And then what does that mean for financing, and ideally labeled financing as well? And so for those of you interested in what we're doing at Moody's, you can catch me for drinks afterwards.
Well, I think also one living remark is let's also invest a lot in training, because still, here we know a lot about green bonds, but out there in the market, not everybody knows so much about it. If we say that today 26% of the primary market in Europe, corporate bonds, is green social sustainability bonds, it's a huge number. I think probably less than 1% of the financial industry knows about it. So it's super, right. So he's a green bond fund manager, so he knows very well. No, but it's important to do a lot of training with our clients, with pension funds, trustees, financial advisors. So invest time and effort and money into that, because it will pay off. Because still in the market, many people think that if you invest in a green bond, you're going to make less money, run more risk, or it's a super niche instrument. And it's not true anymore. So I think that's also another angle that sometimes is underestimated.
Excellent. Little plug for training. Green bonds training is something we've been doing for quite a lot. Find out more. Some of you may have been in yesterday's training. And we're doing some joint training with the International Capital Markets Association soon, starting off in Hong Kong, I think is where we're going. But anyway, Simone might know, I can't remember. We're joining forces is the key point, to try and create a consistent story around the planet. Thank you, everyone, for the tools. Thank you, our panelists, please.